Okay. Here we are, guys and girls. We are here to help you out. This is Singlog Analyst. For you, I am Joe. Okay, I'm the CEO of Chainlog, and we are here for you to learn. And if you have any question, just ask to me. I will try to watch the chat in a little bit. I have 1 hour, so if you have any question, I'm here for the entire hour. Maybe we'll wait 1 or 2 minutes if anything, just because people may enter and before starting. Anyway, if you have question, meanwhile I'm here. Meanwhile we wait, I am be glad to answer. For now, I've opened a new account here on TradingView, so we can take the asset technical analysis from the beginning and maybe see what the market has for us in this moment. Starting from the basics, I have my indicators right here that are RSI bands, so relative strength index. The green line is actually the 30, so the oversold level, and the red lines right here are the overbought levels. This in the middle is the middle RSI at 50 on all over the chart. I think this indicator is actually useful to track RSI without having to watch an RSI indicator below, but just watching the price where it can be of any support or a resistance. So this is one indicator I will use today. The other are simple moving averages. These are the 200, the 50, and the 26. Why these are actually the SMAs we are going to use? Because they are the most used by all traders. Okay, and 200 SMA is actually the yearly moving average of any chart, taking in consideration so the medium price the asset is valued in an yearly perspective, and the same is for the 50. So the only difference is the 50 is a quarterly value of the asset. Instead, the 26 SMA is the monthly value of the asset for the price action ES in. I'm seeing now if someone, okay, no question for now. And the last indicators we'll use today are the EMAs. I'm gonna use the 20 EMA, the 50, the 100, and the 200. The EMAs and the SMAs are different because SMAs are actually slowly to react to the price action. Instead, the EMAs are waiting more the last candles, instead of having the same candles waiting the same. So it wait more the recent price action, and so they are more fast to react to the price action itself. And as you see, I use the 20, 50, and 100 and 200 to assess obviously if we are in a certain manner in a positive or not price action. the 20 and not the 26, because we are using the 26 on the SMA and the 20 to the EMA because it's faster, so we can assess better the short-term price action, if it is going to be a short-term price action that is bullish or bearish. As you see, until we are not reclaiming it, at least we are still in a very short-term price action. And to assess the quarterly, the same for the 50 that is here, the biannual, the annual, half a year, so 6 month perspective is right here, the 100-day moving average, and the yearly is the 200 here. I use the same colors so that you can understand. You see here the difference between the two. Those are actually faster. The EMAs are actually faster to react, and so they are more close to the price. That's not the case for the SMAs. And all of these lines provides not a support level meaning not a real support level, but a level to watch, because it has it has meaning for the people to know what value as an asset in that amount of time past of price action. Okay, still watching if anybody. BTC, okay, BTC falls to 19,200 before few minutes. Do you expect bounce up or continue to fall? So your question is if I think the actual price in the short term will actually fall below 19k and 200. Well, for this we are still overvalued. As in the daily chart, we must watch the 4-hour chart, because it gives us more detail on the actual price action. Your question is actually on the short-term price action, and the more we have to watch the short-term price action, the more we have to go through shorter time frames that gives us more details of the price action itself. Actually, for your question, we could see the 30 minutes, until maybe the 4-hour chart. As you see, let's take away the noise of the SMAs. SMAs are still good for the majority of time frames above the 4-hour, so 4-hour to a monthly chart. Maybe you should be better off just using the EMAs for the 4 hours to the 1 minute to 4 hour charts, so the shorter term transaction, because they are fast, and with all these infos they are better to use. So to answer your question right here, removing all the noise and using the EMAs, this is the oversold level. Just watching the price action with little indicators. You don't have to know every indicator, every metric, every oscillator on the technical analysis side. You can also trade knowing some indicator that you can use well. It's best for you to use indicators actually that suits your price action, that suits your trades, that suits yourself, and that you can use and you understand in all of their part, in their mobile part, because otherwise you'll be watching nothing than just noise. On the 4-hour chart, as you see, we have here the oversold level that is sitting 17k actually. So this is a level that will provide support for the shorter term price action, so in 4 hour, 8 hour, 12 hours, okay, 1 day or 2 at least. The 20 EMA is currently a resistance, because we retested it more than one time on the way down. We retested it right here, as you see, is the yellow line. Okay, the yellow line has been the shorter term price action indicator, actually, that is the 20 EMA. We retested it as a resistance and we fell below again, and we are now retesting it for the third time, and actually it seems like it's still resistance, so we may experience a little bit of a downtrend for sure. The more we can say more that this is actually an higher high, okay, an higher high, sorry, a lower high, and this instead was an higher low. So what does it mean, all of this? I will be explaining it in a second. Meanwhile, this is also a lower high, and we fell below here into a lower low in this chart. So this trend right here is actually a trend, a downtrend. When you see lower high and lower lows, that is another this is another lower high. When you see lower high, lower lows, lower highs on the chart, you are in a downtrend. Without taking in consideration anything and any indicator, you can see all the price action itself. This means we are in a downtrend, okay? So knowing that we are in a downtrend, if we want to trade in a single way with the market and not going against the market, we should think about the fact that we are in a downtrend. We are retesting for the third time the 20 EMA as a resistance. We are not oversold at all level. Instead, we are actually more or less less far to more resistance above, and we have this line right here. So for the time frame, for the 4-hour time frames, what it tells us is that we are going to experience a little bit of a downtrend. Maybe we can still getting an higher low, so a little bit of not all the way down right here, but maybe a little bit of support will be provided right here. But to know where other support could be, we should watch the 2-hour chart, the 1-hour chart, and all other charts to have the maximum information, the maximum confluence, to know where the price could be. Here today, I'm not actually telling you what to do with your money. I wanna express this thing. I'm not here to tell you, well, guys, you should enter here, you should go here. I'm not a financial advisor, and I will never be. I'm an educator, and I'm trying to help you understand how the markets, how the price action is going. What does it mean if a certain price action is going down? Where we can find support, resistances, and what I think about the market. Understand that not only this market right here, but also markets like the S&P, so the stock market, what's happening in the world and why we're seeing this downtrend. All these things are all correlated, and I'm here to help you understand all of these things, from technical analysis to the broader market. Okay, so we can see that the actual 4-hour chart is different from the 2-hour chart, and is different from the 1-hour chart, from the same EMAs, same indicators. here we are seeing that we are actually in I have the term. Wait a sec. I don't have the term in a shrink. Okay, we can shrink again right here. In the 1 hour chart, we may shrink if we just get a trend line right here. Let's see. Okay, so we could in fact position ourselves right here, but there is a 50 RSI going in support, even if the majority of the time we are not seeing the 20 and the 50 RSI doing as a support. So still weaker as a price action. I think in the next few days we can experience a little bit of a downtrend, and even if we are oversold on every chart, as you see, because we are not seeing that much of a demand here. Actually, in the shorter term, I'm not advising you to do anything, because it's really choppy as a price action, and also there is no demand, there is no healthy a healthy market right here to do speculative trades. You can always do, but that's your responsibility, so you have to watch yourself if it's a good trade or not. If you want, I'll try to make you learn more about price action, learn more about EMAs and what we could experience if something is happening, but I'm not just advising you nothing, and I will never have, nor I shield my bags to you. I understand that this is not financial advice, only education. Thanks. Thanks you to have tuned in here and to actually be eager to learn and knew more things about the markets, because the more we know, the more we can share, the more people knows about the markets and how their behavior, the more we can be prosperous together, and so make more and better investments decisions. And with a world with people that are all prosperous, we are going to benefit, every one of us, from it. So this is actually what I'm seeing here on this chart. But my personal advice, actually, for anybody, personal advice, so not financial one, like always. I have to say it because my lowers are actually going to be mad at me if I'm not saying every time I could. And so and so, you know, I have to say it and to cover my ass, they say. And here, what I will do, it's actually removing all the noise right here for a second and watch the price action from a really big perspective, because this is what high net worth investors are watching right now. They are not watching the daily, the 4 hour, the 2 hour, the 1 hour, taking to a speculative move. Only real traders are doing that, and they are day-to-day traders, so they are putting in stop losses and everything when they trade. They are not average people. They do it as a work, and they are not only trading here. They are trading also in the futures market, so in the derivatives market. High net worth investors, instead, that want to invest in an asset, they watch monthly and weekly at the very least, if they have to see more details about the price action, but mostly they are watching the monthly candles. They enter the market, they wait for 1 year, 2 years. When they see the price is undervalued or it is overvalued, they enter or exit the market. Right here, as you see, if you watch the RSI from a monthly perspective, watch it right here. This is the red line right here is the 70 RSI, the overbought RSI. It actually got break in December 2020 and still made a support for all the price action until April 2021 when we saw this doji. This is a candle of the real insecurity candle, okay, insecurity candle, and it means that the buyers and sellers do not know where the market could be. So indecision in the price action. If you see something like that on the bottom or on the top, so a little bit of a body, you know, right, what are the parts of a candle right here, because this is important at the very least to know a little bit of a price action perspective. What are the behavior? What is the behavior of the market in this moment, to know if buyers or sellers are stepping in or not, if the price action is seeing a lot of demand or a lot of supply instead. This is really important. If you do not know anyway, these are there is a body in the candle that is this large right here part of the candle. So the larger part of the candle, that is the price action that is comprehended inside the opening and the close of the candle. Instead, the shadows, those little things about in the candles, are actually the other parts of the candle, and there is a maximum and a minimum. And when you see the body, to express myself about the doji, when you see a body that is the less than half the shadows, you can think about it as an indecision in the market, an insecurity of sellers and buyers about the price action. So you can argue that this is could be a change in the trend. If you see a doji right here changed the trend, and we got down below here. This is another doji of insecurity, of indecision, and we in this case we changed the trend again. There is like 80-90% of the time, maybe 70. It depends on the chart and time frame you watch, but most of the time when you see this kind of doji right here, they signifies a change in the trend. You most of the time don't know when it will happen, if it will happen that time, because there are times in which the price action is actually so bad that it keeps dipping, and this is the case for this last one. This is actually a gravestone doji, more or less, but let's not talk about this. Let's take this apart for now at least. In this case right here, it's not an indecision itself about the price action. It's about the broader market, the conditions that are in the broader market right now, and in the global economy, in the global states as well. And we are experiencing a lot of troubles around the world. I can actually make an argument right here. I'm watching now if there is any question more than this. Okay, there is not. So to talk about this broader market price action right here, we are seeing that apart from the Fed that is raising interest rates, that is not the only bank that is doing that. If you don't know, the Bank of England is raising interest rate. Swiss bank is raising interest rate. European Central Bank is planning to increase interest rates to fight inflation, but in this case we have more problems because Italy and states that are called PIGS actually are in a bad situation financially, and if it happened that the ECB is going to increase too fast these rates, probably they are going to default. And so they are making extraordinary sessions to make an argument about the possibility of these states not to plummet. But what does it mean for you or for us? Because if only one state is going down, if financial economy, if financials markets are globally intercorrelated, if one goes down, then you can have a contagion at every level in any other countries. Because think about that, you are a state which hold actually not only your debt or your money, but also you have investments in other companies, in other countries, in other currencies, all over the world. And if one of this is going down, it brings down your balance sheet too. So this could be an effect, that a snowball effect, when the first ball you throw down the mountain is getting bigger and bigger and bigger and bigger until it becomes impossible to stop. And so one fail, and this brings another to fail, another to bankrupt, more companies, more states. It's a snowball effect. So this is why we are concerned about the issues of the global market, okay? Not only because the S&Ps are plummet or the Fed is going to raise interest rates. Actually, it is a reason, but it must be considered in the entire global financials and economy as well. And if you think this well, there is not only this that is actually fighting inflation, because Fed and every other central bank are fighting inflations. I'm gonna talk right now more than watching the charts, so I'm going only face right now so you can actually see me. We are not only seeing this kind of things about the Fed, because the Fed, like other banks, can fight inflation with the raising of interest rates, and that's okay, but they cannot let's say fix supply chain issues coming from the COVID restrictions we have faced in these 2 years, neither from the zero COVID politics that are going on in China, neither they can stop the war in Ukraine with Russia and every other states. Now we can assess also, we can make an argument about the fact that really the majority of the countries are actually putting arms and other things in Ukraine, okay? There is not a single state and a single war could expand. It could expand really fast. That's its concern, cause a concern for me, for example. And they cannot do anything about that because they are not a political association. They are not a political party. So they have to obey. And try to, even if they are a separate entity, for example, from the state, they are still have the mandate from the state, and their mandate is to retain price stability and inflation low, So, and low unemployment. This is the dual mandate of the Fed: low unemployment and price stability. To have that, they have to slow down the inflation, but they can't at all. They can't only fight the inflation they made with the printing of their money. And in this case, so they are just playing with fire. So they are trying to get to a point where interest rates are actually tackling their issuance of money, new money in the market, but there will be a certain point where even if they raise interest rates to 200%, okay, that is just to say here, is just to make an example, they cannot really fight inflation. They will just repress the economy, putting them in a recession, because there will be no more fighting inflation that comes from an augmented price for wheat, for example, or corns, or any other food that is coming from other countries. Like the major exporters of wheat and corns, for example, are Russia and Ukraine, two of the major anyway. And to Russia we have sanctions against Russia, and we have the destroyed camps of Ukraine that are unfeasible to seed actually, or to use. And also we have droughts in the US. Here in Europe, the people are actually talking in TVs also of city other droughts, and we are actually experiencing that maybe in this summer, and we don't know yet. We have still more problems coming from the fact that oil from Russia, that are one of the major exporter of also of gas, natural gas, and so electricity produced in that manner is going to increase the costs of all European and US citizens as well. We are going to see a very hard winter if we are not prepared for this. We may experience that, but not this winter. If not this winter, anyway, you probably saw already what are the price and how the market is reacting to that, and to all of this I'm talking about now. You can see yourself right here that on a weekly basis, what's the oil? It was down here. Okay, it was down here on April of 220. It was down here, and what's now? It has done like you could assess that if you really was so good that to take the bottom right here was in 110x return. So this is obviously to make an argument about the fact that we are seeing every and single problems getting together to this market. And another argument that I did in the last live stream was that of the DXY. I don't know if you watched it, but DXY is actually the index of the US dollar paired against other currencies that are actually weight that that the most weight are getting it from the year and the JPY. So the JPY and the year are actually those that weight more in this index. But also with other other currencies. In this case, we are seeing this DXY raising, and we hear every day that this is bad for the price action. I made an argument, and in fact, it is bad for the price action of every asset, because when you raise the US dollar denomination of an asset, you meanwhile the asset itself is staying right where it is. So with the same US value, we are buying one Bitcoin. So let's make an example here. Bitcoin is 1. So if we divided this by the US dollar, if US dollar is going to increase in value, okay, to buy one Bitcoin, we will need less US dollar. So if you take the ratio, so if you divide, actually it is that we need more. We need less less US dollars to buy we need more US dollars to buy the same amount of Bitcoins. Okay, if inflation is perceived, if there is inflation, instead we don't we see Bitcoin plummet because the US dollar is increasing, and so we need less US dollar that has more value, okay, has actually more value to buy the same amount of Bitcoin. I don't know if I'm expressed well, because I'm trying here to express myself a little bit. I'm not really English, as you already noticed. Maybe I'm just trying to express myself in a better way. Maybe if you don't understand something, just ask. I'm here for this, to help you out. And what else we can talk about? I've prepared, if you don't have any question, I'm watching here if there is also hot weather right here. I have prepared also some monetary policy right here from the Fed. This is the report from the Fed talking about stable coins, actually. And this is something of value for us to know, because they are actually we can actually read it together. So they're talking about stable coins as a financial a threat to the financial stability of the system. So they're not talking well about stable coins at all, and we should understand why. The recent trends experienced in markets for stablecoins, digital assets that aim to maintain a stable value relative to a national currency or other reference assets. So they are explaining right here what a stablecoin is. And other digital assets have highlighted the structural fragilities in that rapidly growing sector, and they are taking into exam probably the UST collapse, and also the USDT, the peg. For a little bit of time, we saw actually in last few days USDD, the peg. I warned my followers on Twitter about this, that could be happening, and still warn everybody to not invest if it's not a financial advice. Obviously, I'm just this is just my opinion. To not go into stable coins that are not backed by fiat in this moment, because they will be regulated, and also they are not safe as for the protocol itself. It's unfeasible to have that amount of a yield from a stable coin, like 20-30% from a stable coin. This is actually unsustainable in every single way possible, and we will see as well with USDD. We saw with UST. and if they are not counterbalancing or putting something better in place, like over collateralizations, that could help. But with a 30% yield, it's a little bit of a gamble, in my opinion, and I'm not going to invest in that. Anyway, where we were at, where was it at stablecoin here? Funding risks at domestic banks and broker dealers are low, but structural vulnerabilities persist at some money market funds, bond funds, and stablecoins. Still, they're still taking consideration stablecoins as vulnerability of the system, and they are taking into account the stablecoins have internal structural vulnerabilities. This is a report from the Fed. I say this again, and they say the aggregate value of stablecoins, digital assets that aim to maintain a stable value relative, and they again this is the description of a stablecoin, grew rapidly over the past year to more than 180 billion in March 2022. Okay, the stablecoin sector remained highly concentrated, with the three largest stablecoin issuers, Tether, USDC, and Binance USD, so the BUSD, constituting them more than 80% of the total value of the market itself, but not the entire market. They are taking into account the stablecoin market, and alone Tether, USDC, and BUSD were 80% of the total stablecoin market at that time. Okay, in March 2022. The collapse in the value of certain stablecoins and recent strains experienced in market for other digital assets demonstrate the fragility of such structures, and they are talking about USD right here, and more in the pegs of the others also. More generally, stablecoins that are not backed by safe and sufficiently liquid assets are not subject to appropriate regulatory standards, create risks to investors and potentially to the financial system, including susceptibility to potentially destabilizing runs. And here they are talking about the fact that, as you saw back with USD, if you have a bank run and your protocol is not ready, you are going to see not only the peg itself, but the crash of the entire supply of your currency. In this case, also they are taking into account the fact, for example, that the only way you can count on a stable coin is that is 100% backed by real USD value, and this is the case. This is the case for USDC, and USDC is actually backed, but not the USDT, because USDT have more commercial papers that are not actually safe assets to back your stable coins. They are not real money sitting into a bank account. Still, they have so much of a share in the market, as you see right here. Let me help you here. Let's watch USDTD. They have actually at this moment 8.65% of the market share. So for all the market itself, their weight is 8%. For every single dollar that is in the crypto market, there is 0.08 cents of USDT, as well as 0.06 cents of USDC. In total, the two, for every dollar you have more or less 0.14 cents for every dollar in the market that are sitting on the side of the market, waiting to buy, waiting for a better time to enter the market. And they're just increasing. They're still increasing, and they will increase every time. And so Anyway, if you want more detail about everything I talk about, and every detail you get to bet, I have real in-depth charts for the chain log, obviously premium inside the chain log info in my company, and there I share with other chain logs my thoughts better. Obviously, these charts are actually without any price action, without any technical analysis. We cannot obviously stay here talking about all technical analysis perspective and also the rest of the market, and so to learn with you. I do this on a daily basis for the premium channel, and I do 1 hour 30 minutes of a market update for them also, so they know better what's coming. And I am not taking consideration this kind of watch list, but more watch lists about everything that is correlated one another, for the BTC dominance, for the market of the S&P, for anything else. For now, anyway, we see that this is the case about stable coins. Stable coins are actually a risk for the the Fed report that is this. I can put it on the link on the chat maybe, so you can also watch it or download it. I'll put it on the chat right here. Thank you for your English is okay. And so okay, it should be out now. And so stable coins are a risk, not USDT, not USDC in this moment, but also USDT is at risk, even if it has a large market cap and still has that mechanism where you can redeem your USDT inside the company itself for $1 value, and so they're bringing the peg together if they have this large amount of backing. So it is not really safe, but is the riskier choice for the safer stable coiners right there. Where were we? More generally, stable coins that are not backed by safe and sufficiently liquid assets. I think this, yes, these vulnerabilities may be exacerbated by a lack of transparency regarding the riskiness and liquidity of asset-backing stablecoins, and this is an arrow direct to the art of Paolo Arduino, that is the CEO of USDT, because they are not transparent with their with the asset backing their stablecoins. In addition, the increasing use of stablecoins to meet margin requirements for leveraged trading in other cryptocurrencies may amplify volatility in demand for stablecoins and heighten redemption risks. They are talking about the derivative markets and the collateralizations of the use of these stablecoins in those markets, actually. And those markets could destabilize the spot market itself, and also they are actually taking into consideration the fact that the stablecoin could see more demand for this, also for these sectors right here. The President Working Group on Financial Markets, the Federal Deposit Insurance Corporation, and the Office of the Comptroller of the Currency have made recommendations to address prudential risk posed by stablecoins. So they are controlling stablecoins actually at the Fed also. A routine survey of market contacts on salient shocks to financial stability highlights several important risks. Stresses in Europe related to Russia's invasion of Ukraine or in emerging markets could spill over to the United States, as I just said, that could be a snowball effect. In addition, higher or more persistent inflation and greater than expected increase in interest rates could negatively affect domestic economic activity, asset prices, credit quality, and financial condition more generally. So there are not only the broader market, but also the tightening of the monetary policies by the Fed that are actually threatening the gross domestic product of the USA itself. And as concerns over cyber risk have increased, U.S. governments, agencies, and their private sector partners have been stepping up their effort to protect the financial system and other critical infrastructures, and that is true because we saw that, for example, not only the Fed itself, but I think the SEC also have put in place a mechanism like a team to actually investigate in cyber risk about not only the stablecoin but also in the protocols. They have a task force. I don't remember the name actually. They have a task force to investigate in ICOs, in everything that concerns them. And here are also they are also talking about the fact that we see on average that more and more DeFi protocols are hacked, and there is hack all over the place. You see an hack here and there every day. You heard about a new hack, a new exploit, everything that is of a cybersecurity settlement. Okay. So these risks, if realized, could interact with financial vulnerabilities and pose additional risks to the US financial system. And this is the phrase we are talking about. They are actually saying that stable coins are a risk. With all this happening around the world, they are also a risk to the financial stability of the US financial system. And so we must expect regulations from that, obviously, because when you see USD getting down to zero and billionaires with huge amount of money lost in the system and VCs and everything else, something changed. And the Fed, not only the Fed, the SEC, but the government itself is requiring some inquiries in these stable coins, in this market, to assess if there is no fraud, there is no scams, and it needs regulation. They will say this, it needs regulation, and we will see regulation about stable coins, about the market itself in the next year or so. And we will see if it will be actually pro stablecoin or not, or pro crypto or not. Even if we are just saying that some is pro, some is not. Even in politics or politicians as well. We are seeing this, and we will see what will happen from this perspective. The more you can actually read by yourself, they talk about the invasion of Ukraine and commodity markets, as I already talked about. We'll have some problems from the food supply also by there, and this report is 77 pages, so take your time. If you don't have anything to do, just take and pass through, because the majority of the things that are in this report right here are things that the whole market itself knows by now, but not every retail, not every person, not every average citizens knows about this. And I'm here trying to help you out, people, and maybe get them to understand what are the things that are important to know at this date, so they can protect themselves better. So this is everything I have to say. This is a tweet right here that I used, and now we saw back then that we saw that the DXY was strong. I was expecting it to reach these levels and get back down to the 0.03 0.382 level. And actually, if we see the DXY now in the daily, we're seeing this happening right here. This is what actually was, and this is what, and I was expecting something like this. That was a cap and handle actually pattern. And maybe if this, obviously don't take in consideration this line right here is not taken to 110. It is just what the pattern is. Cap and handle is a pattern where you have a curve like this, more or less, and you take it from the higher high, then you come back a little bit and retest, you make a bull flag, and then you trend higher. Okay, this is what is a cap and handle pattern, and that is one of the most traded pattern in the technical analysis. Also, I have made some VIX here comparing on Twitter, also some VIX comparing the chart from the CME to the VIX. And as you see, when the VIX, what is the VIX? VIX is actually the volatility of the S&P 500 that takes into account options to forecast a 30-day perspective of the volatility of the market itself. So it's used by, and this is the VIX, is used by market traders to or investors to assess the sentiment of the market. When it's above 30, it actually means that the market is at a fear level, a really high fear level. Instead, when it's below 30, more or less in the 20 or below, is not the fear is not so high and perceived so high. And as you see, every time where it's more than 30 here on the VIX, that is this orange line right here, against the BTC CME in this case, but you can take the BTC chart, the normal BTC chart as well. You see that every time the market sentiment is fear, we see a dipping down of the BTC price action itself. And when we fell below the 20 of the VIX, we see an increase. And also right here, as you see, we get down below right here, and start trading sideways. Then we had this huge spike right here, also on the S&P, and more or less a little bit before. Meanwhile, people, maybe there was some insider trading, or I don't know, but before it happened, the price action actually plummeted. And also right here, and right here, and right here, every single time that we are in a spot where the VIX is getting to a top and then getting down, we see the market actually, like you see right here, the VIX is getting down and the price action is getting up. We see the market react in an inverse manner. That is important. That is another important indicator to watch. And I just this is just a tip for you. You may very well have it on your trading view also, and as well. And there is an argument here to be made about the Bank of Japan and the JPY and their yield curve control with their 10-year bond yields, but I'm not going to today because it's late and I have to go in 2-3 minutes now. So what I can say is that it was a pleasure to meet you guys, and it was a pleasure also. I don't know, sorry if I don't know exactly how to spell your name. Maybe you can take it, you can help me in this way. It's been a pleasure anyway, and maybe this of any help. We'll see next time. You can just follow me on Twitter. You can watch my Chainlink .info site if you want to have more insight every day like this. in reality, actually, it's really more in depth because I do on-chain, I do fundamental analysis, I do everything I can, technical analysis, and a lot of data. And anyway, if you want more, you can follow me there. The links are down below, and we'll see you next time. Cheers.